Britain's largest online loan provider is set to proceed with an IPO on the London Stock Exchange. Well, Funding Circle announced its plans this morning. The 8-year-old company plans to raise about £300 million selling new shares on the London Stock Exchange. Well, existing shareholders will also sell stock in the IPO. Joining us now is Samir Desai, Chief Executive Officer and co-founder of Funding Circle, and Simon French for Panmure Gordon is still with us. So, Samir, welcome to the program. First of all, how's it going? I mean, Brexit must be impacting some of the smaller loans, or is it on the other side that actually you're benefiting from it because of the uncertainty?
So let me start by just telling your viewers about the Funding Circle story. Funding Circle.
No, we'll get to that in a second. But when you look at Brexit, does it actually hurt or hinder you?
I think I'll just talk about the business first, if that's okay. So we are a platform that allows anyone, individuals, institutions or government to lend money directly to small businesses. We've done £5 billion of loans through our platform, $1 billion of which came in the first half of 2018 alone. And actually, if you look at the business since Brexit in the UK, it's actually grown over 171%. So at times like this, banks typically pull back from the market, whereas platforms like ours are really able to stay open for business and can keep supporting those companies. And
do you have an average size of the loan? If you look at the high volumes that you're explaining as actually banks, pulling back and you kind of coming in, what typical kind of loan is it for?
So we don't lend to startup companies. These are all established small businesses. On average, they've been trading for about 10 years. They have about 8 employees. The average loan size is about £65,000, but it ranges from £10,000 to £500,000. And actually, the business doesn't just operate in the UK. We're also in the US, Germany, and the Netherlands. But the average loan sizes, things like that, are pretty similar. How
big a role will scrutinizing your debt play in actually growing the company?
I think it will be important. I mean, no one takes risk more seriously than us. We've employed hundreds of people from financial services institutions, technology companies. We've aggregated huge amounts of data. And actually, if you look at our platform, on average, the net returns to investors have been between 5% and 7% a year over the last 8 years. So we are delivering this better product for investors as well.
I know last Friday you sealed a deal to sell $1 billion in loans to the US. Are the US and UK markets very different?
I think what's remarkable about our business is that actually we focus on this sub $500,000 pound euro part of the market. And we see that banks don't really care about that type of lending. It's a very small part of their balance sheets, normally about 5% on average. So we haven't actually had to change the product really in any of our markets in the US, Germany or the Netherlands. Really excited about the $1 billion purchasing commitment from Alcentra, which is one of the largest asset managers in the world, to purchase loans from us in the US. I think what it really shows is that we're really starting to get traction outside the UK as well. And the US and Germany and Netherlands actually are collectively 7 times as big as the UK market, so it's a really big opportunity for us.
Simon, when you look at loans, is it something that actually the Bank of England looks at or should look at in the UK? I mean, they look at it, but should they look at it more?
They have been looking at it for the last couple of years, because unsecured lending in the UK has been growing at between about 8% and 10% for the last couple of years. It's about £220 billion. And the Bank of England, through the Financial Policy Committee, has tried to pare that back. It's uncomfortable with loan growth in excess of nominal GDP, so it's looking for more like 4 or 5%. You're starting to see that come down. What's really interesting is there's a lot of structural growth in that marketplace. So step back from the macro story, there's still plenty of demand for credit. The challenge in assessing any business like this coming to the market is, has it been through a full cycle? And we're quite late in cycle, and therefore one of the questions you always pose is, what do default rates look like? To your opening question actually to Samir, which was around, if Brexit becomes quite disorderly, what happens on default rates? How quickly do those ramp up? We haven't got an awful lot of data, at least for about 10 years now, and does that really have much relevance?
Yeah, so this goes back to the debt question. How difficult is it to kind of model, given that we're going through Brexit?
Well, the first thing I would say is that what I think you were referencing time is unsecured consumer lending, which is much bigger than pre-crisis levels, actually.
Yeah.
If you look at small business lending, it's still much, much smaller than pre-crisis and hasn't been growing very much. So banks have continued to pull out of that part of the market. It's very much underserved. If you look at the way Funding Circle does loans, the average interest rate is about 10% a year, and the average bad debt rates are in the 2 to 3% range. So loss rates could treble before people or investors would lose principal. And actually, we regularly run the same stress test as the PRA does for banks. And our expectation is that in a downturn, losses would roughly double. So investors would still get a positive return. But it's a very good question. I mean, we haven't been through a downturn. However, all the modelling, the team that I've assembled, has gone through that, and we're very confident in our relative performance.
One of the questions, just to perhaps save Fran's voice, one of the questions we would have in the UK is Wonga, another loan but more towards the consumer side, have really suffered from, gone into administration recently, from retrospective policy making. So a regulator comes along and goes, actually your pre-2014 loan book is subject to a different set of rules. Do you worry about a regulator who appears to retrospectively revisit the operating environment which you've had to operate in thus far, and should investors worry about that?
I don't think so. I mean, the first thing to say is we lend to small businesses versus consumers, which is a very different regulatory environment. The second thing, in your comparison with Wonga, I mean, our interest rates start at 1.9% per year, and on average at 10%, not in the thousands of percent. So we actually believe that we're offering loans at rates comparable or cheaper than what they could get at banks. And on top of that, 5% of the lending through the Funding Circle platform actually comes from governments. The British government purchases loans through us, the German government purchases loans, the European Investment Bank, the European Investment Fund, 16 local councils. I think what governments really like about what we're doing is we're really providing choice for small business borrowers to allow them to access finance to grow and expand. And the lending we did, Oxford Economics have run a report on this, estimates that the estimates were that it created and sustained 75,000 new jobs last year across our markets, and added nearly £4 billion to economic value or GDP. So it's a very, very different business model to the consumer, and attracts a very different regulatory and government response.